I just hit a £50,000 investment milestone, but instead of celebrating, I realized I've been making one simple mistake that's likely cost me thousands. In this video, I'll show you the mistake, how I fixed it with a massive £20,000 investment, and how my new easy strategy can help you build your own portfolio effortlessly and from scratch. By the end of this video, you will have a clear picture of my entire portfolio and a blueprint for how you can invest confidently while avoiding my mistake. So how on earth did I get to £50,000 invested? You might be thinking I got lucky or have a secret six-figure salary, but the reality is much more normal. It all started back in 2021 when I accidentally invested £10 into a stocks and shares ISA. I was earning around £25,000 a year at the time, and it was a tiny first investment and only returned me 10p, but it planted a seed and showed that I was interested, if not committed, to the idea of investing. Now, it wasn't until 3 months later, when my salary increased to about £28,000, that I got serious and decided to invest £20 a month consistently. This investment ended up returning £10 over that year, so just a modest return, but on the plus side, I basically 100x'd my first investment. Anyway, as my salary slowly increased, so did my contributions. When I was earning 33k, I was investing £350 a month. At 39k, it was £600 a month. And recently, on around £40,000 a year, I was putting away over £1,000 a month into my ISAs. And that's how I did it, slowly, consistently, and by avoiding lifestyle creep. But here's the mistake I was making. Okay, so this mistake is best demonstrated over a few small errors that when combined together build up a clear picture of the true mistake I made and how to avoid it. To demonstrate the first error I ever made, let's dig into the returns I made after my first year of consistently investing. When we look at this statement, a few things do jump out at me, and we can see the £10, 10 pence that was carried over from my accidental investment, and that I contributed £240 total, which makes sense as I didn't miss a month. I earned £10.97 from my investments that year, which, okay, is not bad, but here's the fatal error. I actually lost a whopping £4.29 of the gains from this investment through fees. I can tell you right now, that's way too high of a price to pay an investment platform. It's a fee of 1.8% in simple terms, and when you invest, any fees you can pay can be made up from different categories, such as management, platform, and fund fees. And what I paid back then was way more proportionally than it should have been. When I compare it to what I pay today, the £20,000 investment that I made recently had no management or platform fees, just a 0.12% fund fee. And that means that for every £10,000 invested, it'd cost just £12 in fees per year. It's a way better deal than an option costing 1.8%, because in that scenario, you'd lose £180 every year per £10,000 invested. And over the years, this would add up to thousands, if not tens of thousands lost, because it's eating into your returns. And on top of that, higher fees decimate the compounding effect so much that you are left with returns agonizingly below market rate. To sum up this first error, know your fees and make sure the rate you are paying for is not higher than it needs to be. Now for the second error. This one is deceptive because on the surface, it can look like you're being a really smart, diversified investor. Take a look at this list. These are the main funds in my portfolio. But this is a classic case of what I now call accidental overcomplication. Of these funds, 3 of them were essentially the same thing. I own the HSBC FTSE All World, the Invesco FTSE All World, and the Vanguard FTSE Global All Cap. It's like buying a tub of Quality Street, Roses, and Cadbury Heroes for variety, only to find out they all contain a strawberry cream, a caramel, a toffee. You know where I'm going with this? Sure, the packaging is different. And some people do have a preference, But you're ultimately buying the same collection of stuff 3 times over. I wasn't adding any real diversification, I was just adding complexity. And what about the other funds, like the ESG screened fund or the US fund? By adding these, I was actually making my portfolio less globally diversified, and I was favouring certain types of companies which undid the entire point of buying a global fund in the first place. This actually created 2 huge problems for me. First, anxiety. That feeling in the pit of your stomach when you're never sure you're doing the right thing. Because my investments were spread across all these different funds and platforms, I was just paralyzed. When I had money ready to invest, I had no idea where to put it. Which of these tubs of chocolate was I meant to top up? The confusion was exhausting, and it's a big reason that £20,000 sat in cash for so long. Second, this complexity helped actually hide the fees we talked about in the first era. Because I was juggling so many funds, I was blind to the fact that I was paying a premium on some of them. My complicated strategy wasn't just stressful, it was costing me more money than it needed to. So the lesson here is that more doesn't always mean better. A simple, clear plan is often far more effective and cheaper than a complicated mess that just leaves you feeling confused. So what's the fix? It's all about making investing so simple that it becomes almost boring. My new strategy is to consolidate and simplify everything down to a single core investment plan. And to kickstart it, I finally invested that £20,000. This money had been sitting in my Trading 212 account as cash for quite a while. And I'll be honest, I was nervous about what to do with it. With the market having seen a big drop not long ago, my brain was stuck on one question. Is now really the right time to invest such a big amount, or should I wait? It's that classic fear of timing the market, a myth that can keep us on the sidelines for way too long. Part of me dreamed of using that money for a deposit to build our own house one day, but after looking into it, building a house isn't on the cards anytime soon. It's a huge, complex project for the future. So with at least a 5-year timeline, it was time to put that money to work. And after a lot of research, I invested the full £20,000 into a single fund, ACWI. I think that's how you say it. But to eliminate any doubt, I'll put the full name of the fund on screen, along with its unique code. Think of it like a product barcode. You can type this code into almost any UK investment platform to find the exact same fund. This fund means I now own a tiny piece of over 1,700 of the biggest companies across the entire globe. It's globally diversified, it has very low fees, and my favourite part, it's an accumulating fund which automatically reinvests the dividends. For those of you who want to see other funds that I considered, I've put together a whole comparison table that you can download for free using the link in the description. Now, by investing this money, I am giving up a guaranteed return. That cash was earning me about 4.2% interest, which works out to £2.35 every single day. And seeing that guaranteed money come in every day was nice. But let's look at the long term. A 4% return on £20,000 is £800 in a year. The stock market historically returns an average of around 8 to 10% a year. Now let's be conservative and say 8. That's a potential £1,600 a year, and I'm trading a guaranteed 800 for a potential of 1,600 or more. Over 20 or 30 years, that difference could be hundreds of thousands of pounds. And that is a trade that I personally am willing to make. So with that huge £20,000 investment now made, how does my entire portfolio look right now? Let's run through the numbers. On Vanguard, I now have £24,390. Trading 212 is at £20,137. That's the big new one. My Doddle Lifetime ISA sits at £7,345. My 2 private pensions from old jobs are at £10,807 and £9,605 respectively. And my Invest Engine account, which I'm just getting started with, is at £129. That means that in total, outside of my pensions, I've now personally contributed over £50,000 that I've saved from my income over the years. And the best part is the growth. This month alone, the stock market has been kind. My portfolio grew by an unrealised gain of £1,276. And that's money that my money made for me without me lifting a finger. So right now you can see the complexity I was talking about. This portfolio is actually kind of the before picture, the result of my accidental overcomplication error that I just walked you through. And the goal for me going forward is to simplify all of this, and that's pretty much the next step in my investment journey. Now, remember that question that kept me stuck? That fear about whether it was the right time to invest? Let's quickly bust that and a couple of other common myths. Firstly, that big one, waiting for the perfect time. If you're waiting for a sign for the market to feel safe, especially after a crash, then you will be waiting forever. The truth is, the best time to start was yesterday, and the next best time is right now. Secondly, let's address the idea that investing is just gambling. For me, owning a diversified slice of the global economy is the exact opposite of gambling. It's a long-term plan based on the simple fact that over time, the world's best companies grow and generate profit. And finally, that old argument to just live your life instead of saving or investing. For me, investing isn't about sacrificing your life. It's about buying your future self more freedom and security so that you can truly live life on your own terms. My big takeaway from hitting this £50,000 milestone is that a simple, clear plan is everything. It removes fear and allows you to act with confidence. So if you want to see the next step in this journey and get the exact, simple, step-by-step plan that I'm now building to consolidate everything that we just looked at, then you need to watch this video right here. It's where I break down my new strategy in full detail, including how I am going to invest more than ever, effortlessly in 2025 by making some small changes. Thank you so much for watching. Don't forget to like and subscribe, and I'll see you in the next one.